Jeff, the current thought or wisdom across Wall Street is that rates are going to be headed down from here on in. We're going to get cuts from the Fed going forward. So what does this backdrop mean for you with rates on the decline?
Yeah, I think we need to actually back the boat up a little bit and really assess how confident we should be that rates are going to continue to fall. And absolutely, I think the Fed is right to be focusing, and the market is right to be focusing on the reality that we're starting to see cracks in the employment market. But importantly, we also have to remind ourselves that the Fed not only has a second mandate, but they have a third one as well. And that second mandate, the one of focusing on price stability, is really where I will draw attention. But that plays into the third mandate, which I'm going to define. And I think we've got lots of reasons coming out of Jackson Hole, but I will define as inflation expectation stability. And so what we saw with CPI recently is roughly 60% of prices are rising at above a 3% inflation rate. And that should cause the Fed to step back and really assess how confident we are that inflation expectations are anchored. And we have to pair that with ultimately the reality that the labor market is declining. And so I pair that just a little bit with spreads are very, very tight in today's environment. And I think investors may be ahead of themselves.
Okay, so can you expand on that a little bit about how investors should be positioned if you think that inflation may be a little bit stickier and we're not going to be heading down rates as quickly as perhaps I thought they were?
Yeah, so we need to, again, focus on where we are in the backdrop. And so what we've seen is we're starting in a very strong spot. But over the last 4 quarters, we've seen leverage in the high yield market increase. And what we've seen is the 4th quarter in a row where margins have compressed. So we're in a strong starting place, but we're heading in the wrong direction. And spreads are very compressed. The margin of error in the world of fixed income today is very, very low. So I think investors are best suited to focus, again, away from the equity market and a little bit more on the fixed income, the ballast part of their portfolio. But within the world of fixed income, taking every opportunity to take potential for volatility out and focus on keeping yield and return roughly constant.
So with this in mind, how are you building portfolios for clients?
Yeah, I think focusing again on that ability to extract potential volatility where you're not being paid to take that volatility. And so the way I'm thinking about that is we're shortening credit duration. We're focusing less on the world of high yield, more on the world of investment grade. We're focusing up the capital structure. And we're really focusing on more acyclically oriented companies to build the best long portfolios, long tenured portfolios for our Aristotle Pacific clients.
And in Aristotle Pacific, you focus on something called relative value. You harness relative value. That's something that you talk about a lot in your marketing material. What exactly does that mean?
Yeah, I think it's actually one of the most persistent and consistent sources of alpha generation for investors in the world of fixed income. Very quickly, the way I like to think about it is the world likes to silo. We like to think of equities as distinctly different from fixed income, but even within fixed income, we like to think about the world of asset-backed securities being distinctly different asset class versus the world of corporates. And at the end of the day, a bond is just nothing more than the timing, the quantity of cash flows, and the probability we're going to get those cash flows. And so an investor that can look across those silos has the best ability to keep yield and total return constant while taking out potential sources of volatility. And we at Aristotle Pacific really think that key, that focus on relative value, is the key to building resilient, high Sharpe ratio portfolios.
And then finally, we're in a traditionally volatile time of the year when it comes to equities and fixed income trading. So what should investors and advisors be on the lookout from here on in?
Yeah, I think really what they should be focusing on is the outcome of what they're trying to achieve. And so balancing volatility can be great for active managers like ourselves. But again, I think it's really, especially in the world where I live, the world of fixed income, that volatility is very asymmetrically skewed to the downside. And so my focus and what I advise clients to be focusing on is how to keep and how to harness and really lock in the high yields that we see today, equity-like returns in the world of fixed income, and make those very durable into the future.
All right, well, thanks for coming on and talking about it.
Absolutely. It was great seeing you. Thank you.